Most people think a safe retirement account means earning 3 to 4% and just being grateful it's not in the stock market. They're wrong, and that mindset could cost you 6 figures of growth. Today, I'm going to show you how fixed index annuities are quietly offering double-digit cap rates and what you must know before you chase them. Look, fixed annuity rates are the best they've been in about 15 years. As of this week, top 10-year fixed annuities are paying around 7.6% guaranteed, and A-rated carriers are still in that 5 to 5.6% range. At the same time, the 10-year Treasury is hovering around 4.3%. That big gap is exactly why fixed index annuity caps are so attractive right now. Some of the strongest S&P 500 index caps I'm seeing in April are 8%, 10%, even north of 12% on certain terms. So yes, FIAs can be fantastic accumulation tools, but only if you understand how those caps actually work and how quickly they can change on you. Here's the trap most people never see coming. The cap you're sold is not the cap you keep forever. Insurers can reset index caps every year on many products. This week, one 8-year FIA from Midland National bumped its cap by 0.75%, up to about 9.3%. Another carrier is posting over 11% caps on a 10-year term. Great news today, but that cut both ways. If interest rates fall or hedging costs spike, that same company can drop your cap from, say, 8% down to 5% at the next reset, while your money is still locked into the contract. Your principal is protected, yes, but your future growth assumptions just went out the window. That's why rate integrity matters more than the shiny number on the brochure. So how do you actually use FIAs for accumulation without getting burned? Start with the index options and crediting methods, not just the headline cap. Annual point-to-point with a reasonable cap on a broad index like the S&P 500 is simple and time-tested. Check whether caps are locked for the full surrender term or reset annually. Compare that with alternatives. Right now, the S&P 500 is up over 3.5% in just the last 5 trading days and has been extremely strong all year. But that also means more volatility risk if you're fully in the market. An FIA lets you participate in a slice of that upside with no downside loss, but you're trading off some of the extreme years because of the cap. For pure accumulation, that trade-off can make a lot of sense. If you're within 10 years of retirement and you want your money growing, but you can't stomach another 30% market drop, this is where FIAs may fit. Just don't buy based on one cap snapshot in April of 2026 and assume it lasts forever. Ask the tough questions. How often can you change my caps? What's your current renewal history? Do you lock in rates for multi-years? And how does this compare to simply taking a 5 to 7% fixed rate instead? If you want help sorting through those details, follow for more and visit us at myannuitydoctor.com. That's where we break this down in plain English for real retirees every single day.